Cost Accounting Chapter 2, we talk about cost concepts and behavior of different types of costs. So cost versus expenses. So costs are past, present, or future cash outflows. Opportunity costs are costs that are past outlays. So we have already outlaid the cash and we've already kind of lost that benefit and we can't go back and recoup it. So those opportunity costs should no longer be relevant to our current decisions because they're past outlays of cash that can no longer be recouped. An expense is a cost that is charged against revenue in our current accounting period. So here we have an income statement, again, very, very kind of basic, but we've got our sales less our cost of goods, in this case, cost of services sold. That gives us our gross profit margin, less our marketing and administrative expenses gives us operating profit. So again, revenues over those costs and expenses provide us profit. Then here we have ones where we're not performing services, but where we are we're producing product. So at the top, again, we've got our sales revenues, but now it's less our cost of goods sold, gives us our gross profit margin, less those marketing and administrative expenses or costs, gives us our gross profit. And down below, you do want to understand how to calculate this statement. Really, you want to understand both of them. But we've got our beginning inventory plus any purchases that we make during the period, plus any transportation in costs that we had to pay to get that merchandise in. That gives us our total cost of goods purchased, add that to the beginning inventory, and those are our goods that are available for sale. Then we subtract what's left in our ending inventory, and then the difference is what must have been sold. Because if we had it available and we no longer have it on hand, then it must have been sold out, and then that's what we're going to charge out to cost of goods sold on our income statement. So you do want to understand the flow of this and to be able to prepare both of those statements when you get into your homework. Okay, then here we have, again, just the same basic principle. And again, now we're focused maybe a little bit more on what type of costs these are. So our product costs are what is in our inventory and then charged out to cost of goods sold as they're sold. Our period costs are our marketing and administrative costs that are charged off against expense in the period that they are sold. So that's what this is. So our product costs are costs related to our inventory that we're selling. Our period costs are any non-manufacturing costs that are related to the firm. So like those general administrative type expenses. Product costs are associated with inventory, and then when they're no longer in our inventory, they're charged out to cost of goods sold. Period costs are expensed as they're incurred, and they're matched up to the revenue in the proper period. So these are our direct costs that are associated with manufacturing a product. So we have direct materials and then direct labor. So if we're talking about building a chair, obviously all the materials that you see in that chair, the seat, the back, the wheels on the bottom, or the pedestal it sits on, whatever it is, those are all direct materials. But then somebody took them all and put them together. So somebody created those different component parts and then put them on an assembly line and constructed that chair. So the person who put it all together on that assembly line and constructed that chair, that would be the direct labor. Now then we can have indirect costs that we can't trace directly to the product, but they're still a part of the product cost because they're necessary. So like indirect materials, indirect labor, other indirect type costs. So those things go into that manufacturing overhead. So let's say, use my chair example. Well, there's probably like screwdrivers and screws and WD-40 and things that are needed on that assembly line that maybe don't actually go into the chair itself, but they're still necessary to get that job done. Then you may have a person who works on the floor and takes the component parts and takes them over to the assembly line, then takes the finished goods and moves those out to the shipping dock. That would be an indirect laborer. They're touching the product, but they're not actually adding any value. They're just moving it. Or the maintenance guy who has to come in and maybe fix the assembly line if it gets, bogged up and it's not moving properly. Again, he's there to help, but he doesn't actually touch the product and add value to it. And then you could have electricity, heat, insurance, all those types of other indirect costs that are necessary but not adding direct value. So those are kind of what I'm describing. The things you can see and you can touch and add direct value are those prime costs. So our direct materials and our direct labor. The conversion costs are the costs that are necessary to convert the materials into that finished product. So again, direct labor is involved in there, like the assembly line people who are putting it together. And then there's manufacturing overhead, again, to run that assembly line. Then our general and administrative expenses and our marketing expenses, those are recognized at expense as they're incurred. So like advertising, sales commission, shipping costs, so not the freight in, not to buy the materials that we need for our inventory, but if we have to pay shipping to get the product to our customer. Our executive salaries, our IT function, any legal costs, any insurances, all those things would be administrative. So then how do we allocate the costs to the product or the service or to the business unit or whatever it is, especially when we have multiple different departments? So the cost allocation process, we first define the cost pool. So what are we assigning the costs to? And then we determine the allocation rule or the method that will be used to assign those costs. And then we assign the costs that are in that cost pool to that cost object. And again, that could be a product line, a department, those types of things. So here we have an example. We've got the East Coast and the West Coast division. So in total, our revenues are $100 million, $80 million from the East Coast, $20 million from the West Coast. And what we're trying to allocate is the IS department's costs of $1 million. So we've determined that the IS costs are going to be allocated based on the percent of the revenue. So if we have 100 million total, 80 million comes from the East Coast, that's 80% of our revenue. 20 million from the West Coast is 20% of our revenue. So that 80%, 20% is how we're going to allocate out the $1 million. So the East Coast is going to get 800,000, West Coast is going to get 200,000. Okay, then this next section talks about our manufacturing cost flows. So again, we're assuming we're a factory, that we're producing product, and it's various levels. So I'm going to switch my example. So I worked at a plastic injection molder early in my accounting career, and we made air vents for various car lines. So think about the air vent. There's little plastic component parts that are put together into that vent, and then that vent is popped into the dashboard of the car. So our raw materials inventory were the plastic pellets. So we had a variety of different type of plastic pellets, and they came in these big, boxes that we had to move with the tow motor. Those were called gaylords. So we had a raw material inventory warehouse with all of those gaylords of the different types of plastic materials that we needed to make these various parts to go into the air vents. Then, so we would take the necessary raw material out to the press. They would put it into the press along with the mold, and then they would create the vanes, the thumb wheel, the housing. So, and there was a link. So there was a link that the vanes went into, a thumb wheel that moves the vanes, and then a housing that pops into. So we made all of those on the presses differently, at different presses, so we'd have 7 different presses. We could be making the vanes, the link, the housing. So we had all those going, and those would all be considered work in process because I can't sell the vanes, I can't sell the housing, I can't sell the link. I want them to all go together. So we would mold them out there in where our presses were. Then our floor people would take those work in process inventory and take them back to the assembly lines. And then our assembly line would put them all together. So they'd put in the link, pop in those vanes, put the thumb wheel on, or no, probably put the housing on, then put the thumb wheel on to hold it all together. And then that was a finished good. That's what we could sell. They'd box those up, goes out to the shipping deck, and we would sell it to our customers. So each different level, again, had a different, obviously, inventory number, and we kept track of it differently. So then now here kind of shows you more of like an accounting equation flow of it, but then just kind of get the big picture of how it flows. So in our raw material, like when we purchased all those plastic pellets, we'd buy those, we'd put them into our raw material inventory, and then if we kind of had a computerized system where we kind of knew how much should have come out for production, but if you're just doing it real manually, you'd go out and count what was left, and then you'd say, okay, well, if I had all this raw material available to me, this is all that's left in my ending inventory. The rest must have been transferred into work in process. So then that's what we see the arrow going in there. What's no longer in our raw material went into work in process. And then we have a beginning work in process inventory balance. We add in these direct materials. We add the direct labor and the manufacturing overhead. So for my example, it's the press operator, it's the electric bill, and the maintenance supervisor and the manufacturing supervisor or manager, who were all part of that process, so they'd all be part of that overhead. We'd add all of those up, and that's our total manufacturing costs. Subtract out what's left in our ending work in process inventory, and then that difference is going to get transferred over into our finished goods. So we'd have a beginning finished goods inventory. We'd add in all of those goods that were completed and transferred out of work in process. So like in my example, all the product that then got moved over to the shipping deck where we're going to box it up and send it. And those are our goods available for sale. And then if we didn't send them right away and they still sat there on the shipping deck, we're going to subtract out that finished goods inventory, and then that would be our cost of goods sold. And then that cost of goods sold ends up on our income statement. And then again, here's an example of that income statement. And then here's an example again, and like I said, you do have to know how to do these for your homework, to do a cost of goods manufactured and sold. So what did it start with? Our beginning work in process inventory, what happened in our direct materials that then what ended up going into production, add our direct labor, add that manufacturing overhead, and this is our total manufacturing costs incurred. We add that to our beginning work in process inventory, and then we subtract out what was left at the end of the year. And then that would be our cost of goods manufactured, and then that goes into our beginning finished goods inventory. So we have what was available to sell less our ending finished goods inventory, and that becomes our cost of goods sold. So now that we have these different layers, this schedule is a little more detailed. So you might want to kind of have that printed out or in your notes so that you know kind of the flow of that. Then we talk about cost behavior. So some of this stuff should be reviewed from managerial accounting, but we'll talk about how does it respond to changes in our sales or our activity levels within a relevant range. And the relevant range is what basically we can produce without adding on or something like that. So we have fixed costs that remain unchanged as our volume changes or our production level changes. So say we're paying rent on this facility. It's not going to increase based on how much product I produce. We're just paying for that facility itself. Same with like insurance on that facility. It's not going to increase based on how much product I produce. It's just that same amount. Variable costs are ones that are going to change in relation to the product that I produce. So obviously our direct material and our direct labor, the more you produce, the more those costs are going to be. Those are the best example of variable costs. Commission on a selling of the product, that's also a variable cost. And it's always within a relevant range, which is really what is your capacity. Because say you've got that factory that you're renting, it's only so big. There's only so much you can do. Even if you run 7 days a week, all 3 shifts, that's the maximum you can do. So that would be your relevant range, is within that. Now you can have semi-variable costs. So I always feel like utilities are a bit of an example of that, because even if you shut the plant down, you still have to pay an electric bill and a heating bill and a water bill, because you're not going to vacate the whole thing. You're going to still have those. But then say you're running 7 days a week, all 3 shifts, obviously your heating bill and your electric bill and your water bill, all those are going to go up. So there's kind of a stagnant, whether you're working or not working, that you got to pay. But then as you do more, those go up. And then you could have step costs where it's within a specific range and then it jumps up, specific range and then jumps up. And maybe those could even be like, maybe commission. I don't know. I'm not, can't think of a good example of a step cost where it's, certain number of units and then boom it, and then it jumps up a little bit. So then our components of our product cost, our full cost is all of the manufacturing and selling of the product. Full absorption is all variable and fixed costs to manufacture the product. And then variable is only the variable costs, the ones that go up and down per unit and don't include any of the fixed costs. So here they give you an example, or so that you could kind of see it mapped out. So our full unit cost covers everything. Our full absorption, notice it doesn't cover marketing and general and administrative. It only covers the product costs. And then our variable costs are not product or full. I mean, it's just got truly what's variable. So direct materials, direct labor, our variable piece of the manufacturing overhead, and our variable piece of marketing and administrative, like that would be commission. So our full absorption is when we're doing our financial reporting and our generally accepted accounting principles. Our sales revenue less our cost of goods sold gives us our gross margin. For management, sometimes this variable method is more meaningful. So our sales revenue minus our variable costs gives us our contribution margin. So that contribution margin we need to then cover our fixed expenses in order to break even, or if we want to have a targeted profit. And again, here it just kind of shows it to you in a different way. And then this, I feel like too, is just kind of showing you it in a different way to say the full absorption method includes our variable and our fixed manufacturing costs. But it also includes those period costs, which are the variable or fixed marketing and administrative expenses. The variable piece only is the variable costs. So our direct materials and our direct labor and our variable overhead would be included there. And then our variable selling and marketing and administrative costs. And then we would lump all of the fixed costs, which could be, some of them could be manufacturing, and then the rest would be the marketing and administrative. So again, just they give you different graphs to kind of visualize and think that through. But you definitely do want to understand the regular income statement and then our contribution margin income statement, and then what are the differences between like the full, the variable, and then the what was my other one? The full absorption, the variable, and the I guess that's it. The full absorption and the variable. You want to just understand the difference between those two. And again, they give us just a variety of little graphs.